We'll be also broadcasting it to Facebook. This way you can get the link also. Okay, and now we're going live on Facebook. All right, hi everybody, welcome to tonight's presentation. I'm Sami Abusad, Director of Education at T3 Live. Hope you're doing well. Tuesday afternoon with our usual lesson, coaching session for Strategic Day Trader members. This time it's also open to the public since we are in the middle of an open house. If you'd like to join us, if you're just on social media, would like to join us, link is in the description, okay? So hope to see you there. All right, we're gonna go ahead and get started. Let me take my face down, my webcam down, and talk about, this is going to be actually a follow-up, or part 2 rather, to the lecture that we started yesterday. I got lots of positive feedback about yesterday's discussion, about the topic we discussed yesterday. I hope you will enjoy today's just as much, okay? Before we start, as always, my least favorite slide is the disclaimer, but it is true that trading is risky and that whatever we discuss today is for educational purposes only. But you know, a lot of people think, well, it's risky. It may be risky for other people, but for me, I'm a genius. It's not risky. It is risky. If you don't think it's risky, then you haven't really assessed the risk correctly. It is risky. You have to assess the risk correctly and be able to manage it. That's my job as 90% of the time. My job as a trader is a manager, actually, a risk manager. So I'm just managing risk. Most of the time you can manage risk through share sizing. That's it. Most of the time, that's all you need to worry about is share sizing. But there are instances where you also have to think about the volatility of the stock, or if you're involved in options, there are other things that would have to be considered. At any rate, whatever we discuss today is for educational purposes only, okay? All right, let's go ahead and get started. So again, we started yesterday by saying that there are 3 ways to trade any earnings season. One of the ways was to do it through guerrilla trading, what I call guerrilla trading, meaning you get in it the day before earnings. Okay, you get in the stock before earnings. It's something that I do every single day. Just about every single day, I find earnings plays that I get in before the close. The second way is by day trading the stock once they report earnings by day trading their stock the next day. So you can do that too. Today we took a couple of trades. One of them I mismanaged, which was the YUMC. But that worked out nice, actually. Would have worked out nice if I had kept it. And then the other one was the BWA, was a good one. And then I scalped the letter I. It was pretty good, actually, and not a bad day. I mean, it wasn't the greatest of all time, but let me just see. There it is, just like $1,500 today. That's, I don't know. Those are the fills. 1521. So not bad. It was okay. And then the third way in which you can take advantage of earnings season, taking advantage in which you can the third way you can take advantage of earnings is by trading them after they gap, by swing trading them basically. Swing trading gaps after earnings accounts for about 50% of all my swings. Would you believe? 50% of all my swing plays come from either igniting gaps or exhaustion gaps. Can you believe it? It's mind-blowing, because I only discovered this strategy in 2010. So that's only, well, it's been a while, 10 years ago. Feels like it was yesterday. But 50% of all my swing plays, they don't come from breakouts, they don't come from pullbacks, they don't come from climactics, they don't come from whatever. All the classic patterns, the head and shoulders, cup and handle, all of them. No. They come from actually gaps. And then almost 100% of my intraday plays come from gaps also. So as you can see, I'm a gap trader through and through. Now, in terms of, let me do a recap to what we talked about yesterday. We said that guerrilla trading is an income-producing style that utilizes a sniper's hit-and-run approach. It looks to buy a stock on Tuesday, today, only to sell it the next day at the open, or some people like to hold it for a couple days on Thursday. Conversely, it calls for shorting a stock one day only to cover the next day or two. I use the daily chart, but I also do pay attention to the weekly and the monthly when I'm playing earnings, when I'm getting into earnings. But those are the only 3 time frames that are used for guerrilla trading. Yesterday we talked about my most cherished trading tactics, right? And they actually fall within the context of guerrilla trading. I've always taught that a trader needs only 2 to 3 highly reliable trading tactics. In this case, you get 6. Now, I'm not going to go over all 6 strategies that I went over yesterday, but I just want to briefly show you give you a recap, show you what the premise, the concept is, and welcome you to the professionals trading circle. How about that? All right. First, keep in mind that this strategy, I only started trading it with real money, even though I discovered it in 2010. I only started trading it 7 years later, in 2017, and it really made it on the map, so to speak, after I did this video where I reviewed the play of the week. I was doing just the play of the week video every week, and I did this video, and T3 saw the video and thought, wow, this is really impressive. $78,000 net in 1 month of trading earnings. That's got to be really impressive. The program at the time used to be called Nightly Game Plan. Right now it's called the Strategic Swing Trader. So if you want to get this video, the link is down here at the bottom. You can just write it down or something, or just Google Nightly Game Plan. It should be the first video that comes up, the very first video. Okay, and that was the video where I showed my performance for the month, 66,000 with E-Trade, and then my options account, small account with E-Trade, I netted 11,625. I think it's pretty small, but the two combined amounted to exactly 78K. But that's what put this strategy on the map. I didn't want to teach it in the beginning. Really, that's why I never told T3 about it, because I didn't want it to get. I don't want people to know about it. I was afraid it would lose its edge. But thankfully, I'm happy to report that I have almost 500 members, strategic swing trader members, trading the same strategy, and no effect. Knock on wood. Okay, so that's that, and I want to say that my big aha moment came when I started wondering first I started seeing this gap, this type of gap, specific type of gap, while scanning TC2000 every day. This program right here, see it? I have Apple in the background. Apple is reporting. So this is the program that I use for swing trading, for scanning, and I started to notice a certain type of gap happening almost every day, every single day. So once I figured out that, hey, this thing has got consistency to it, this gap type, started wondering, what's the common catalyst behind all these gaps that I'm seeing every day that worked? And then more importantly, can I be in the stock before the gap actually happens? Because I'm risk averse by nature. You wouldn't believe it probably. If you were in the room with me, you'd think I'm a risky guy, right? I like risk. No, I don't. I'm really risk averse, big time. And so I don't like to jump in before a stock reports. I just don't do it. And that's why it took me 7 years before I finally said, the heck with it, I'm doing it. So I discovered that the main catalyst was earnings, was earnings. And I asked myself, the next question that just naturally popped up was, can I use the basic unit to trade earnings? What's the basic unit? This is the basic unit. It's the way in which all stocks move. Not going to review it. I already did that yesterday. I just want to show you what it looks like for those that maybe didn't attend yesterday's talk. So this is the basic unit, and this is all I know how to trade. I can trade this pretty well based on which stage the stock is in. There are 4 stages: stage 1, 2, 3, the top, and 4, the sell-off, the downtrend. So I can, and then there's also the transitions A, B, C, and D. I'll show you that later. So I know how to trade the stock by identifying which stage it's in, and whether it's transitioning or not. But if this gap strategy that I just happened to stumble upon doesn't fall within the framework of the basic unit or the atom, then I'm out of luck, because I'm an accountant. I like to put things in boxes, and if they don't fit in boxes, I'm not going to do it. And luckily, I figured out a way to do it within the framework, as I said, of the basic unit, which is the only movement possible for stocks. Okay, so I discovered a strategy. I developed a strategy for doing this transition A play, earnings strategy. Developed a strategy for doing transition B. Developed a strategy for transition C, transition D. Right now, B and D are similar. A and C are similar. C is a little bit different than A, but it's not much different than A. C is when you're playing the stock short. A is when you're playing the stock long. B is when you're shorting it as a climactic sell setup, and D is when you're playing it as a climactic buy setup. I also developed a strategy for playing stage 2, the uptrend, and then I developed another strategy, so 6 strategies in total for trading the stock through earnings while it's in a stage 4 downtrend. The basic premise behind it, happy to share it with you. Really, I was extremely nervous about sharing it a couple years ago, but now I'm happy to share it because we have, as I said, we've probably even passed 500 members, and I can still operate the same way without any issues. Okay, of course, other educators out there, I know of at least one educator that's now doing earnings like I do, getting in at the close, out the next day at the open, copying me. But that's no problem. Go for it. Good ideas are usually copied, so no problem. That just confirms that what I do is pretty good. At any rate, the basic premise behind it is I want to find, if I'm playing long, I want to find a bullish stock. This is the premise. It's really important you understand the theory. I want to find a bullish stock with low expectations. You got that? That's it. If I'm playing long, I want a bullish stock, but has low expectations for what? For earnings, for a good earnings report. If the stockholders, if the investors and the traders, short-term traders that are active in the stock have low expectations for it and it's bullish, it's really easy to just hop over that bar if it's set very low. All you have to do is just a little bit. All the company would have to do is report even just okay numbers. They don't have to be stellar numbers. Okay numbers if the expectations are low. But if the stock is bullish, what that means is this company has a history of reporting good numbers. Otherwise, it wouldn't look like this. Let me show you. It wouldn't look like that. Does that make sense? It's only bullish in an uptrend, because the company basically moves up from quarter to quarter. So that's the idea behind it. Now, the other thing you have to figure out is, well, how do I do it? How do we do it? How do we share size? How do we manage? When do I get in? When do I get out? Does that make sense? That took me a little while to figure out, probably 6 months, okay? To figure out the mechanics of it, how to do it, how to execute the trades, basically. How to minimize your risk, all of that stuff. But the idea is the same. So other than, the idea which I just shared with you, and the execution part, which you'd have to learn, there's one other thing, which is you have to be able to identify which charts actually look good. So that's a skill. So you have to be good at reading charts. And that's what technical analysis is for. I'm an accountant by trade. I assure you I can read financial statements better than most people out there. because that's what I was trained to do. And not only that, I worked for a top company that did that and I did that for a living. I worked for KPMG, which is a big four accounting firm. It's the Ivy League of accounting firms. So I'm well versed, or I'm well trained in reading financial statements, 10K reports, 10Q reports, all of that stuff. I used to audit them. So you have to know how to read them if you're gonna audit them. But it's meaningless stuff. It doesn't even matter. And besides, I couldn't look at 100 stocks a day, which is what I look at all the companies reporting earnings, if I'm gonna spend an hour or two just analyzing each report and analyzing the news. So I don't care about that stuff. All I care about is the chart. Okay. So as you can see, this is just a sample. Bullish stock rising 20. How do I know that stockholders have low expectations? Because they sold it. The 3 days preceding earnings, they actually sold it. Does that make sense? And it wasn't extended right at the 20. So panic selling means low expectations. The next day, gapped up. You want to play it long. Basically, you want to be in it the day before. So that's made $5,600. Same exact setup, bullish, red bar, right? The day before earnings. The next day it gapped up. That's earnings day. Made $1,800. It wasn't even the best play that day, but those were all earnings plays. I don't get them all right, as you can see. Actually, probably more than half I got wrong. That's fine. But notice I still made $6,200. At any rate, the process for shorting is exactly the same. You want a bear stock with high expectations, meaning investors are expecting it to gap up, because then the company would have to do really well before it can gap up. But the company is in an all-out downtrend. The stock is really bearish. So that tells you there's a misalignment there between expectations and reality. So I want to take advantage of that misalignment, so to speak, between, again, reality and expectations. So I want to short this stock. I did it actually live while I was in Chicago doing the mentorship in person. This GME wasn't such a big play. I mean, it made $4,200, but I only put $10,000 in it, so very little. But it was a huge gap down. This was my biggest play last year. Really bearish, and then retested the 20. It was picture perfect. I did put more than 25K. Usually I just put 25K in each play. So this one I did put more, and it made 22K. I don't know if you can see it. It's pretty small. But it made 21,900, something like this. Okay, and it was my best day last year. Not my best day ever, but it was just my best day last year. $87,000 after commissions, because at the time commissions were not free. So I've just showed you, recapped what we discussed in detail yesterday about how to take advantage of earnings. Okay. Now I want to show you how trends are born on the daily charts, dailies, weeklies, monthlies, but I stick with the daily mostly. So I finally came to understand how trends are born and how they come to meet their end, so to speak, and that is through gaps. There are only two types of gaps in existence. Let me take my picture down. There are only two gaps in existence: professional and novice. Pro, igniting gaps, start or ignite new trends. They are to be played in the same direction as the gap, right? Novice gaps end or exhaust all trends. They are to be played against or in the opposite direction of the gap. So we're going to talk about professional gaps first, right? Which is how most trends are created. And I'm going to talk about, for a minute, the difference between pro and novice. Now, a lot of people think, well, how do I know whether to play this long or short, right? First of all, most of the time, if it's a professional gap, it's only going to trigger long, okay? Meaning the pattern that sets up. So here we're looking for a pattern that sets up after the gap. Got it? We're looking for a pattern that sets up after the gap. Most of the time, it's just a 1, 2, 3. So you get the igniting bar, the narrow range bar, and then long. In this case, we had more than one bar, one narrow range bar. We had 3. So it's like a 1, 2, 3, 4, 5. But instead of saying 1, 2, 3, 4, 5, 6, I just call it a breakout play. So again, if it's a professional gap, you want to play it in the same direction. And how do you play it? You wait for a pattern to set up on the daily chart. Most of the time, it's going to be a 1, 2, 3 play, 1, 2, 3 pattern. Other times, it's going to be a breakout or a pullback. If it's a big gap, you always want to wait for a pullback. Okay, if it's a big gap. If it's a small gap, if it just, what's a small gap? A gap that just clears resistance is a small gap. See this? Resistance, it just cleared it. It could have been a 10% gap. It still is considered small. A gap that gaps up to here, far above resistance, would be too big. Okay, even if it's just 7%, 5%, would be too big if it's far above all reference points on the chart. Now, in general, in order to identify whether a gap is pro or novice, there's a couple of things to keep in mind. One, professional gaps 99% of the time, not 100% of the time, but 90% of the time at least, they gap from the area of the 20 period moving average. The blue line is the 20. I don't know why I didn't mark them here, but annotate the chart. But the 20 is the blue line. The red is the 200. It doesn't matter whether you use SMA or EMA. I use SMA because that's what most traders use, and I want to see what they're looking at, basically. We don't trade stocks, we trade people, right? We want to see what they're looking at. So I use SMA because that's what most people use. So again, if it's a professional gap, it's going to gap from the area of the 20. The day before it reports, it's going to be, the stock will have been trading at or near the 20. So that's how you know it's a pro. That's number one. Number two is most of the time it will go against the most recent trend. Meaning if the stock is down, and then the next day is going to gap up. If it does gap up, then would be considered a professional gap. Or if it's sideways, and gaps up, that would also be a professional gap. What's a novice gap? We'll go over them when we get there, but I just want to kind of show you. Let me see. I can show you like really quickly a couple of gaps. I don't need these charts. I'm going to close out of them. Just one chart is enough. I don't need more than one. So this is the Qs. A novice gap would be, something like Beyond was a couple days ago, last week or a week and a half ago, where the stock was already up a lot. You see it? Up a lot, and then gaps up far above the 20 MA. That's a novice gap. Better than that would be something like the RAD, because it was up. Look at this. Moving average was about $10. The stock was trading at 20 almost. That's 100% extension, okay? 100%. So far above the 20 and then gapped up. That's totally novice. That's tier 1 novice, basically. Got it? Sometimes they're not this good, like ALEC, I guess, was a novice gap. See it? Not as good. Wasn't 100% away from the 20, but it was about 10%, and then gapped up after a move up away from the 20. If the stock is already moving up a lot and then gaps up, that's novice. If the stock is down a lot and then gaps down, that's also novice, but to the downside, so you want to play it long. So novice gaps, we look to fade. Professional gaps, we look to play long, okay? That also applies to day trading. If it's a novice gap, I'm going to look to play it short as a day trade. If it's professional, I'm going to play it long, right? But then also the pattern that sets up on the daily chart following the gap should be played in the direction of the gap if it's professional, or against it if it's novice. So as you can see, this stock gapped from the 20, gapped over a red bar, and then if it's a professional gap, it will always gap, almost always, gap right to resistance or just above. So got it? I gave you 3 ways to identify whether it's pro or novice. You only need one. If it meets one of the 3 criteria, then it should be considered pro. What are the 3 things that I gave you? What are the 3 items that I just mentioned? One is if it gaps from the area of the 20 MA, it would be considered professional. Number 2 is if it gaps against the most recent trend. So that's a sell-off, right? Most recent trend was down and it gapped up. So that's pro. If it had gapped down, then we could have looked at it as a novice because it was down a lot already. But I told you, if it gaps from the 20, then it's not novice, even if it's down, even if it was down 3 days in a row. So if it gaps from the 20, it's pro. If it goes against the most recent direction, it's pro. Right, that's what shock value is if it goes against the most recent color, the most recent bars. So if these are red bars, it means that stockholders have been selling it, shorting it perhaps. So when it gaps up, they're going to be trapped. Okay? When they're trapped, because it gaps, it didn't trade there, it just opened there the next day. As the stock moves up, they're going to look to cover because their losses start to get bigger. As they cover, that's the same as buying the stock. The stock moves up, price moves up. When price moves up, more traders also rush to cover because their losses are getting bigger and bigger. And it starts that snowball effect. So that's what shock value is. Exactly right. So if it gaps from the 20, it's pro. If it gaps against the most recent color, it's pro. And then 1/3 item is professional gaps usually gap just above or just, sometimes they gap to resistance and then they clear it after the open. So this is a stock probably, let me just use a finer line. This stock probably didn't clear resistance at the open. You see it? Didn't clear it, but right after the open it did, probably. So they gap to resistance or just below it and then clear it after the open. That's 3 ways in which you can identify whether a stock is pro or novice. You only need one. If it meets one of the criteria, then it's pro. In which case, if you're looking at it as a swing, you look for a pattern to set up. Now, I don't look at it the day of the gap, I look to day trade it. The day before the gap, if I get in it, I'm playing the earnings. I'm playing it as an earnings play. Got it? So the day before, it would be an earnings play. The day of the gap, it'd be a day trade. I'd be looking at it as a day trade. And then a few days later, I don't look at it the day right after the gap because the minimum pattern consists of 2 bars for me. 2 bars is minimum. So I look at it at least 2 days after the gap. So this day, I don't swing trade it. This day, I don't swing trade it. And then the 3rd day, I start looking at it, looking for a swing entry in it. So as you can see, it didn't trigger until a few days later. But that's how I do it. Okay? 50% of all my swing trades come from this pattern, not this pattern, but from playing gaps, 2-3 days afterward, after they gap. Okay? Now, what would make you go long on earnings? I just went over that, didn't I? Didn't I just talk about it? But I did spend over an hour, I think, talking about it yesterday. So you might want to look up yesterday's video. It's available, and watch that again. But I just went over 50 slides telling you when to play long earnings and when not. Or just send out an email to info@t3live.com, okay? All right, so that's that. Notice this gap cleared 3 months worth of resistance, gapped from the 20, so 100% pro. Got it? Now, how did it set up? It set up as a buy setup. It never triggered long as a 1, 2, 3. It pulled back to the 200 MA, which is support. Beautiful. So long right here. If you're playing it as a swing only, sometimes I play it as a core, long-term trade, not just a swing. If you're playing it just as a swing, then what I like to do is after 2 bars in my favor, I go bar by bar on the daily chart. Notice you'd still be in it here. This is flex, if you want to know which stock this is, because all of these are trades that I took. Some of them I still remember, of course. This is flex, the name of the stock, the ticker. Long bar by bar. Okay? All right. So this one gapped from the 20, from a red bar, and just cleared resistance. It meets all 3 criteria. It meets all 3 conditions. And how did it set up? As a buy setup. So long over the base right here, stop right here, and then bar by bar, you'd be out right here. Pretty nice move in just a few days. I mean, that's a really big move in just a few days, 5 days or so. All right. This one right here, gapped, big gap, well above resistance. I would consider this, well above it. That's the resistance. So on a pullback, and besides, it didn't set up as a 1, 2, 3. But if it set up as a 1, 2, 3, then it would have been questionable. It actually pulled back a little bit. Long right here, stop right here, and then go on vacation if you can. Otherwise, if you can't, then you're out right here, which was a nice little move, a nice big move still. Okay? All right. Same here, gapped up, pulled back, buy setup, long right here, stop under the pivot, and then If you can, go on vacation. Okay, if you like the gap and you really like it long term, go on vacation. Notice the 1, 2, 3 here. What a beauty. Some of you might think, well, wasn't this a big gap from 5 to 540? That's like 10% almost. No, it wasn't, because remember I told you the size of the gap is judged not by the percentage the stock gaps, but by whether but by comparing it to where the last reference point is on the daily chart. If it's far above it, like up here, then it would be too big, way above. If it's just, in fact, in this case, you could have argued it wasn't big enough because it actually didn't clear the resistance. See it? That's the resistance, the topping tail. It didn't even clear it. So one could have argued that this wasn't even big enough, 10% or 9%, however big it was, and it still maybe wasn't even big enough. Okay? All right. So that's the idea. Now notice this stock was transitioning. See it? That's why when a stock is transitioning and it gaps up and it looks good on the weekly and the monthly, it's a core play. It's not even a swing play. It's a long-term play. Again, notice transition A here, and the transition A was triggered, ignited through a professional gap up right here. So long right here, stop right here, and really go on vacation this time. Don't come back for a while. Stock went from like $3.50, $4 to $10. If you did it bar by bar, you still made a good amount of money and you would have gotten out right there. Okay, but again, when it triggers a transition A, it's a core play, it's a long-term trade. Okay, if you're on social media and you're enjoying this so far, please be sure to hit the like button. I'd appreciate that. Also, if you want to join us in the open house, check the link in the description. Gap just above the 200. I love stocks or gaps that clear just the 200, that gap just above the 200 or just below it when I'm playing short. See this? Gapped, big amount, but gapped from a red bar and from the 20 MA and just above the 200. Most of the time they gap above the 200, whether it's novice or pro, it gets bought. So this was pro, and look at the move here. Now managing it, this was difficult. If you tried to do it bar by bar, you would have gotten out quickly. If you did it on pivots, sometimes you can also manage on pivots. If it's in momentum stock, I like bar by bar. If it's not a momentum stock, then I like pivots. And you just keep raising the stop. Okay? Again, if it's a momentum stock, bar by bar. If it's not, then on pivot. Notice this stock gapped from a green bar, but from the area of the 20. I would still consider it professional. But look where it gapped to. Way up there, above all reference points on the chart. That is the kind of gap that's oversized, that you want to play it long on a pullback only. If it triggers here as a 1, 2, 3, I would skip it. I wouldn't do it. But on a pullback to the 20 MA, beautiful, long. And that's how it's set up. That's the beauty, is that most of the time they set up the right way. So that's good. Beautiful, beautiful. Okay, this was also triggering a transition, so this was more of a long-term trade than a swing trade. I think we've covered professional gap ups pretty good. Now, what about professional gap downs? Professional gap downs most of the time are going to be igniting a transition C, a breakdown basically. Okay, gapping from the 20, see it, and then notice the arch. That's what I'm talking. That's the 4-stage cycle. So this is a core play short when it actually triggers a transition. See, notice the breakdown. When the resistance above is larger than the support below, chances of a move down are huge, right? The odds of a move down are very, very high. So short, stop. Look at the size of stop and look at the size of the fall, and who knows where it ended up stopping at. Same here. Notice again the little arch right here, gap down, and then a 1, 2, 3. And then short. Look at the moves, guys. Look at the size of the moves. That's 40% from, not, oh yeah, it is. No, 33% from 15 to $10. 33%. Gapped under the 200, rallied a little bit, and then sell setup, short. Notice this bar. That's my favorite bar of all time. It's called the money bar. It's called the, I call it the battle bar, because it shows a real fight between buyers and sellers. So if the stock breaks under that kind of bar, I want to play short. Especially if I have a strategy there that's called a professional gap down, igniting gap down, that should be shorted. Does that make sense? But that's my favorite reversal bar of all time. It's the battle bar. Notice gap under support, maybe slightly oversized. No, not really. I mean, here's support, $2, gap to 180, and then 1, 2, 3 short. Notice the price of the stock, in this case, 180, some stock, that's 34. I don't care. That's 15, that's 27, doesn't matter. 100, 200, doesn't matter. Now, the higher price stocks tend to get really whippy and spready, so you have to be careful when you're share sizing. But otherwise, the price doesn't really matter. What matters is the pattern. Notice this was in an uptrend, and the gap broke the uptrend, so that's a short. And because the gap triggered basically, so here's the 4-stage cycle. This is stage 2, stage 3, and now the gap triggered the breakdown on stage 4. It's a long-term hold. Got it? It's a core play. Something like this would be considered a core play. It gapped down again here, probably on earnings again, and then now it's a short. The same here, just under the 200, beautiful short, right? Look at this stuff. I mean, it's just, you could fall in love with this stuff, right? So I showed you how to play it before the stock reports, after the stock reports as a swing trade, right? On professional gaps. And now I'm going to show you in a minute here how to do it as a novice gap, okay? Notice again the 4-stage cycle, gap just right here, just below the base to trigger the breakdown, and look at the sell-off. Show me a strategy that works like this, that gives you these kind of moves. Just show me. Send it to me via email. And send me, I just showed you, like we're on slide 77. I just showed you like 50 charts, okay? So show me something that works like this good. I'd be interested, because I don't know of anything that works this well. Okay, look at it. Look at the moves. Look at just huge moves. All right. Okay. So we talked about professional gaps, and now we're going to talk about novice gaps for a minute. I already kind of talked about novice gaps when I showed you the BYND, when I showed you the RAD, when I showed you the ALEC. Right, that was little novice, not too novice, but little novice. I don't know. I mean, every day there's novice gaps. I keep a notebook of the gaps, but I actually just started a brand new notebook, so I couldn't. So I'd have to look at my old notebook if I wanna look up some of the older some of the gaps from like last week. I just started this week. What I do is I print out. So I created a PDF document basically with a notebook. I don't think you can see it. It's probably too white. You can't see it. So it gives me a classification of the gaps, and I just fill it out before the market opens. Fill it out like so, and then I populate the charts according to my notebook. I take the notebook, the file actually. I don't even print it out to FedEx office. And they print it out and bind it for me in a spiral notebook, like so. And it lasts me at least a year or so. That's about 300 pages. And then every year or so, I do the same thing. But last time I printed 5 of them. So I'm good for a while, for like 5 years, for the next 5 years. I don't know if I'll be a trader, a day trader for that long, for 5 years. But I'm about to retire. I keep thinking about to retire, but we'll see. At any rate, novice gaps, as I said, when the stock is down a lot and gaps down, right? 0% chance of me retiring. You better not dare me, GB. You better not dare me, because no, I think I have a couple more years in me. As you can see, I'm not at that age where I need to retire, but I have other things in my life that I'd like to do other than to trade. And I've always said, once I've accumulated enough money to last me the rest of my life and to take care of the people that I want to take care of, that I need to take care of, then I would retire. And I'm at that point where I feel like I can retire if I want to. Knock on wood. I'm grateful. I'm very, very grateful for that. But I also enjoy this. I don't, so it's hard to walk away from something you enjoy. I enjoy trading a lot, but I also enjoy teaching. If you haven't realized yet, enjoy teaching. So when I say, I might retire in a couple of years or so, I don't mean retire from trading. I will always be a trader. Exactly, Mark. I just meant to retire from day trading, because day trading takes about, it takes a while. It takes up a lot of your time. Or I could just do it at the open and that's it. And maybe retire from teaching in a couple of years, day trading and teaching. But I'll always be a trader. I mean, that's just, I love trading. It's who I am. All right, so you're not subscribing to T3. Well, actually, you better get on it. You better get on it, if anything. All right. Okay. So, okay, let's continue. So novice gaps, I'm looking for stocks that are down a lot. See this? Down a lot and then gaps down. With novice gaps that we're looking to play swing, right? This wasn't very novice, honestly, that day, because it gapped kind of close to the 20. So it would have worked as a short more than a long. But with these type of gaps, the stock where the stock is down a lot and then a big gap down, you always 100% of the time want to have a huge volume bar, 100% of the time, because that tells you that most people that want to be out are already out. If they're already out, it means the stock doesn't really have much more to go, if at all. Most of the time it's just the bottom. Okay, does that make sense? So if the stock is down a lot and then gaps down a good amount, like for example, I wouldn't be doing this as a novice gap looking to play it short, because it's a small gap. I'm looking for the big gaps, the big gap downs or the big gap ups to play as novice. Like the ANAB was the last one I think we did as a novice. It wasn't, again, it gapped from the 20, so that's not considered novice. But when you consider the long-term trend, look at this, down from 120, 140, 34 to $10 was the bottom. So that's the kind of play that I like to play long after they report earnings. How did it set up? It's set up as a breakout over the base, stop under it. We added to it on the 1 2 3. That's the 1 2 3 pattern. We added to it there, and then we did end up trailing out. Unfortunately, it took a while. We eventually trailed out right here. So that's when it broke down right here. But it was a really nice trade, really nice trade. And notice it's going back up. Probably goes back up. So I always want to see a spike in volume on that gap. If there's no spike in volume, I will not trade it. You always want to have a spike in volume. So there it is, and then you look for a pattern to form afterwards. In this case, what kind of a pattern? Kind of a breakout. Wasn't really that good of a pattern. Right here, long, stop under the base. It wasn't even that good of a pattern in this case. How about this one? 1 2 3, long, or 1 2 3 4. So long right here. Stop either under the doji bars, or if the bottom of the doji bars is close to the prior bars low, then put the stop under the whole thing. If it isn't, just use the inside bars as your stop. Look at the move, guys. Just look at this move. Pretty amazing, huh? Look at the volume. Always wide range bar, narrow range bar, then you can play it long. So you can't play it long. I don't play it long the day after it reports, but 2 days later is when I start looking at it. So let's say this reported yesterday, then today I wouldn't be looking at it, because most of the time you get a narrow range bar the day after it reports. See this? So wide range bar, then narrow range bar, and then you can start looking for a play, for a pattern to trigger. Wide range bar, narrow range bar. Wide range bar, narrow range bar. So then you can start looking. Look at this. Wide range bar, narrow range bar. Look at the move in this case. You have to kind of lift up your neck to see. I mean, look at the size of the move. Pretty nice, isn't it? So those are the kind of gaps that I like to play long and keep, hopefully, long-term. Keep long-term. All right? So those are what I consider novice. Any questions from the room here? Before you retire, I want to attend your live trading mentorship. I sure hope so. Active. As you know, the next one is going to be next month in person. And there's not a lot of people signed up. So why? Because it starts, it's on the West Coast, so early in the day. So feel free to, feel free to do it. Next one is going to be the week of February 24th. That's right, Amber. Week of February 24th here in the Bay Area, where you trade with me like in an environment like this for a whole week in person. Okay, it's pretty great. What scanning software do I use for these kind of plays? I use TC2000 right here in the background, and it costs only $30 a month. Okay, for the swing trades. But for other plays, for day trades, I use different platforms. Every platform is good for something, but not good for everything. So, you can try and use just the same platform for everything if you want to save some bucks. But in the end, you end up hurting yourself probably more. So I have a platform for swing trading, a platform for day trading, a different platform for earnings, you know, whatever works best, regardless of the cost. But the good news is most platforms these days and commissions are free. So that's great. So that's the amazing news, right? The amazing part. This is Tesla. This is how it's bottomed. Down, 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 gap down. Look at the spike in volume into the 200, into support. And then from there, bam, popped. This is 180. It just got cut off. See 227 right here? So this was 180. That's how it actually bottomed. I had Tesla for a while, but I didn't keep it. And notice this. Gap down after being down for a long time. Spike in volume, narrow range bar, 1, 2, 3 long, and then just go on vacation if you can. Okay, this could have shorted it here, but I didn't do it. I did not do it short. Down and then big red bar and then a gap down. Wish I did it short. Didn't, but I sure played it long right here, and then bottomed for a long time to come. Some of these gaps, I mean, like this is, I don't know if this is Thor. It went to $80. Some of these, like this was the bottom forever, and then it ended up getting bought at $80 or $83. So I've showed you, I trust I showed you enough examples of this strategy. Is this recorded? Yes, it is. Yeah. Okay. Any other questions before I don't want to keep going with the charts. I think we've been doing this for about an hour now, so that's good enough. Any questions about what we just covered? Do you have scanning parameters? I do, but that's a kind of a topic for another day. I've done a video about it, probably more than one video. Ask me tomorrow in the room if you want, and I can show you how I do it. You know, I can bring up TC2000 and show you how I do it. Okay. All right, guys. When you enter the trade, do you enter as soon as it breaks the previous bars or end of day? No, that's a great question. If I am playing it as an earnings play, then I enter at the end of the day. If I'm playing it as a swing trade, then I play it as soon as it triggers. So in this case, let's just say, then I'm not going to wait for the bar to finish forming. Just as soon as it takes out the prior bar's high, then I'm in it long. Because what if it triggers and goes up to here? Now, would I want to get in it up here? No. So as soon as it triggers, as soon as it takes out the prior bar's high, without waiting for the bar to close. All right? Which of the 3 ways of professional gap indicator works the best? All 3 work fine. I mean, work the same. All 3. Usually they coincide. You get all 3 requirements in every gap most of the time. Okay? Can I go over why I didn't play Apple? I did it so many times today, but I'm happy to do it one more time. It was off the 20, so I liked it on the daily as a long, but the weekly was too extended. Climactic, in fact. That's why I said Apple, no play for me. Got it? It's like the same as Beyond. It looked higher yesterday. It was pretty bullish, but too extended. And besides, it was into resistance, so it wasn't really good anyway. It was actually too extended. So, but people kept asking me about Beyond, and today people kept asking me about Apple, which is fine. I understand those are the names that currently are being, you know, Apple is always followed. Beyond has recently been followed, and then before that, when it went public, people were crazy about it, and then it collapsed from like $300, right? From maybe not quite 300, 240 to $80, right? And then recently popped again. All right, too extended. Yeah, that's a good question. What's too extended? It means far from the 20 MA. It's too extended. Now, not every stock that's far from the 20 is considered too extended. Sometimes a stock could gap. If it gaps from here to here, that's not extended. Extended means that that the stock used up the fuel. What type of fuel do stocks need? People, traders, buyers. So when a stock runs up like this, it means it used up a lot of its fuel. A lot of the buyers are already, the ones that want to be in it, already bought it. That's why when it gaps up, I look to short it after a big move up like this. Does that make sense? So, and the extended means it's used up a lot of its fuel, okay? Now, if it's not extended, if it's just at the 20, then it hasn't used up any of the fuel. Or if it gaps, when a stock gaps, how many traders does it take for a stock to gap? 0. every day I find stocks in the pre-market that don't even trade in the post-market or the pre-market. Don't even trade. I mean, liquid, like they do, let's say, 1 million shares a day, but they don't even trade in the post-market or the pre-market, which means it took literally 0 people for it to gap from here to here. If you didn't use up fuel at all and it went away and went up from 80 to 90, is it extended? No, it's not extended. Does that make sense? So we use the distance from the 20 to describe whether a stock is extended or not, but be careful. Sometimes if it's a gap, if the move was created through a gap, then it's not extended, even if it is far from the 20. Got it? I hope that makes sense. Okay, great. All right, everybody, that will do it for tonight. I want to say thank you so much for sticking around till the end. I sure hope you learned something new today and that you liked what you learned, that it makes sense. It's not just mumbo jumbo talking about nonsense. This is concrete stuff. This is what I do for a living, and as you can see, I love it. It's very concrete, has specific criteria, specific rules. So I hope you enjoyed it. I hope you benefit from it. If you did, please be sure to hit the like button. And if you want to join us in the open house, if you're not in the open house already, link is in the description. If you have any questions at all, send an email to info@t3live.com or give him a call. They work better through email, but you can give them a call too. info@t3live.com. Thank you so much one last time, and have a great evening, everybody. Take care.